Good morning, everyone, and Happy New Year to you all. Welcome to the ICG's Digital Academy webinar series. I'm Sally Alsop, the committee member responsible for our webinar programme. So this morning, we're very lucky and pleased to welcome Jay Haran, founder and managing director of RNM Accountants UK Limited, and husband of ICG member Akanksha Haran, who you might be familiar with. RNM UK is a firm of chartered certified accountants and tax and business advisors. Their key focus is identifying opportunities that give their clients a meaningful business advantage. They provide a full range of accounting and business services to enterprises and individuals, helping them to achieve growth and long-term success. Between them, they have decades of knowledge and practical experience. So this morning, Jay will be helping us start the year on a sound footing by reminding us of our business compliance requirements for accounting and corporation tax, VAT, PAYE, and other topics. He's very happy to answer your questions at the end. So when the time comes, please turn on your webcams, raise your hand and ask your questions yourself, or alternatively, just write them in the chat box and I'll read them out for you. So before we begin, here are some of the other events we've got organised for you over the next few weeks. So there's lots in the diary already. And if anybody is interested, there is also a book club meeting on the 28th of January, where they'll be discussing Positive Intelligence by Shehzad Shamin. I couldn't quite fit that on the page, so just in case anyone's interested in joining that book club event. Don't forget that to learn anything more about our great value sponsorship opportunities, please just reach out to Lucy. So now I'm going to hand over to Jay.
Thank you, Sally.
Could you, apart from Jay, could you all turn on your microphones off, please? We're getting a little bit of feedback. Over to you, Jay.
Thank you, Sally, for kind introduction. Good morning, all, and wish you a very happy new year. First of all, thank you, ICG team, for organizing the webinar. I would also like to thank my lovely wife, Akanksha Haran, for connecting to ICG team and suggesting the webinar on accounting and tax matters. So let me share my screen. Okay, I hope you're able to see my
screen. Yeah, that's great.
Thank you. So this webinar, as Sally introduced, is about small and micro entities and the compliances, year-round compliances, which you as a business person has to take care of, which includes different sort of requirements. So most of you have your own business, I assume, in one or other form as listed here. These are the most popular form in which you can carry your business, such as sole trader, which is also called as sole proprietor, or popularly referred as self-employed person. There are then partnership firms, limited companies, and limited liability partnerships. Now, each of these structure or entities has their own advantages and disadvantages. So sole trader or sole proprietor, you have single owner, which is just yourself. Partnership, more than one owner, you may have one or more partners. Limited company, again, it is like one shareholder or more shareholders and the directors. And then comes limited liability partnership, which again, you have more than one member. For sole proprietor, you register with HMRC, get the UTR number, and then start your business. Some people, they normally carry on their trade with their own sort of bank account, which they use both for personal as well as business purposes. Some people, they actually formalize it by giving a trading name and also setting up a separate bank account. In case of sole trader, there's unlimited liability, of course, and also the tax applicable is income tax on all the earnings, less all the expenses, so net taxable income. In case of partnership, again, it's unlimited liability, and partners are jointly and severally liable for any liability which arises for the business. Income tax is applicable on gross earning less any expenses plus national insurance. In case of limited company, normally you register the company with Companies House. It is considered to be a separate legal entity, wherein if you are director or shareholder, the company is different, then the director and shareholders are different people or different sort of SSEs in terms of tax matters. On limited company, the profit earned or net taxable profit earned is there's a corporation tax charge. And again, you have to separately get a UTR number or unique taxpayer's reference number for the company, which is not same as for the individual. Then comes limited liability partnership. Again, you have to register the same with Companies House. It has limited liabilities, same as in case of the company, and income tax is applicable for limited liability partnership. When you set up a business, there are many other things which you need to set up or register alongside your business setup. So let's say you have set up your sole trader or partnership or LLP or limited company. Along with that, you may have to set up a register for PAY, which is a pay as you earn scheme with HMRC. If you have one employee, so you start with one employee, then that registration is compulsory. If you for VAT again, you have to register with HMRC. It depends if it depends on your turnover. If you cross the threshold of 90,000 pound in rolling 12-month basis, then you may have to you will have to register mandatorily with the HMRC. However, you can also register voluntary basis, and there are benefits for registering on voluntary basis. We're going to discuss more about PAY as well as VAT in detail later on. Next is EORI registration. EORI is Economic Operators and Registration and Identification. This is registration is needed for businesses which deals in exporting and importing goods overseas. So for that, you must have EORI registration. Again, it is with HMRC. You're also required to maintain statutory records, whether it is sole trader, partnership, limited company, or LLP. You will need to maintain minimum accounting records, payroll records, VAT records, and also in case of companies, you also need to maintain additional books such as directors register, shareholders register, person of significant control registers, and many other statutory books. For once you set up your business, I would say you definitely need to make sure you have a right accountant who can advise on your business. Plus, you need to set up your accounting books, which could be on various software, or for very small business, people normally use Excel these days. It is getting less popular, but of course, there are a lot of other softwares such as Zero, QuickBooks, and Zoho, etc. For payroll, again, you need to set up either with third-party payroll if you have one, if you need one, or you can use the same accounting software, which is more advisable because then everything is in one place. If you have an employee which meets the criteria for pension, you may have to set up a pension account, or we call it master trust. With the master trust, this is required as per the Auto Enrollment Act. You will have to set up a master trust for your business. Again, for your business, I would say business plan, budgets, cash flow forecast, these are all really important, at least visibility for next 2 years. So it is worth doing those exercises. Next comes employees liability insurance, professional indemnity insurance, and others. These are again quite important and mandatory in a way, so that your business risks are adequately covered. Now, coming to compliances overview throughout the year, there are many compliances depending on the type of business or entity you are running. It depends on, if you're a sole trader, more likely you are going to be required to file your From April 26, you are required to do it via MTD. So MTD compliances, which is making tax digital compliances, I'll discuss that in more detail in the next slides. In case of sole trader or limited company or partnership, or again, limited liability partnership, you have different annual accounting requirements and annual accounting compliances. You may need to file accounts with HMRC or with Companies House or both, depending on the type of entity. Audit related compliances, these are mostly applicable to medium and large companies. I understand that this may not be applicable for most of the people here. However, there are audit requirements from shareholder in case of the company. So I will touch upon that in my slides later on. PAY essentials, what you need to do, what are the PAY compliances? It's regular. We will discuss about that. Then pension related compliances, auto enrollment related compliances, we'll discuss about that in more detail. VAT compliances, of course, depending on the type of the scheme, type of the accounting you do, there are VAT compliances. Quarterly returns may need to be filed. There are annual accounting schemes on annual returns which may need to be filed. Then comes annual corporation tax return with HMRC. That is also one of the annual requirement, mandatory requirement. Otherwise, penalty may apply. Most of these compliances, if you don't meet those compliances in timely manner, then different penalty regimes apply from HMRC and from Companies House. There are various compliances in case of company. We call it company secretarial. These are like updating directors' details, PSC details, maintaining, updating statutory records, allotment of share capital, etc. That we will discuss in compliance for changes in the company. So making tax digital for some self-employed. As you all know, April 26, this is the new requirement, mandatory requirement. This is purely for self-employed or sole trader or landlords. It is not applicable to the companies or partnership or to the limited liability LLPs. If your gross qualifying income is over 50K, then, or if your gross rental income is over 50K, then you need to submit via MTD your quarterly updates to HMRC. These quarterly updates will be in the form of total sort of figures, not line items, not in detail. These are to be submitted. As you can see, standard quarters are from 6th April to 5th July. Due date is 7th August. Then 6th July to 5th October. Due date is 7th November. Then 6th October to 5th Jan. Due date is 7th Feb and so on. You can also choose to update to HMRC on calendar quarter basis. That's perfectly allowed. However, the due dates remain the same. Here, you have to submit via MTD software, MTD compatible software such as Zero or Free Agent. If you don't have one, I think it's high time you choose one and start setting up for MTD compliance. So rules applicable from 6th April, you will have to do quarterly update with HMRC. However, end of period statement will still need to be submitted for each business. This will replace SA100, which is the personal tax or self-assessment form, which we normally do at the year end. It will need to submit all the income and final tax liability. Now, one important thing to note here is taxes are payable only once a year. Although you are doing quarterly update, that does not mean you have to pay quarterly taxes. So the tax payment is still annual. Threshold is based on gross income, not on net profit. So 50K we discussed earlier, that threshold is on gross basis. If your net profit is below 50K, you may still need to do submission via MTD. Now, for each business, you may have to do separate quarterly updates. So let's say if you have land rental business or a property business, wherein your gross income is over 50K, then you will have to separately submit for that. In comparison to, let's say, if you have a self-employed business of, say, market research, wherein your gross income is over 50K, then you may have to submit that separately. As you may all know, the future rollout, of course, April 26 is for threshold over 50K gross income. However, from April 27, if you have gross income over 30K, then you still need to comply with MTD. From April 28, if your gross income is above 20K, then MTD will apply. Now, one important thing, a lot of people, they have property rental income, and most of the time, so there are joint property owners. So let's say if there are two or more individuals jointly holding the property, and their share is less than 50K gross rental income, then in that case, MTD compliance is not required. So it's not on the property basis, it's on the basis of each and every business, each and every sort of individual in gross income. Now we move on to what is micro versus small entity. So there are certain thresholds, as you can see on the screen. If your turnover limit is more than, if is less than or equal to 1 million pound, if your balance sheet assets total is less than or equal to 500K, or if your number of employees less than or equal to 10, out of those three thresholds, if your business meets two thresholds, then it will be classified as micro entity. What is the benefit of micro entity? So micro entity can submit their accounts in FRS 105 sort of accounting standard, which is a very simple format. The disclosure required is very limited. Of course, it is exempted for audit, and the filing with the Companies House, you require sort of minimum balance sheet. And you don't need to do fair value accounting. Fair value of accounting is applicable in case of, say, if you have investments in the business or if you have property in the business, then you can get away with, fair value accounting in case of micro entities. Small entity is, of course, again, you need to meet 2 out of 3 thresholds, which is turnover limit if it is less than or equal to 15 million, or balance sheet total if it is less than or equal to 7.5 million, or employees if it is less than or equal to 50. If you meet out of those 3 criteria, if your business meets 2, then it is classified as small entity. For small entity, you may choose accounting standard FRS 102, and that again, that is slightly more, require more accounting disclosures in case of small entity. And again, it is exempted from audit. With the Companies House, you can file abridged or full account depending on your requirement. One thing to note here is, see, in some cases, you may be classified as microentity. And depending on the nature of your business, you may still want to prepare small entity accounts. And that is really important. Say if you have a lender who is, finance money to the business, in that case, they may not want to see microentity accounts because of limited nature of disclosure in the accounts. So you may still want to prepare small entity accounts so as to give more disclosure for lenders. Let's move on to the next screen. Audit thresholds for UK companies. From 6th April, it is 2 out of 3 thresholds we discussed for small entities. So if you're going back to the previous screen where we have for small entity turnover limit, if it goes more than 15 million, balance sheet total if it goes more than 7.5 million, and if you're more than 50 employees, if you meet 2 out of those 3 criteria, then you are treated as medium entity for which audit is required. Now, there are other sort of requirements for audit. Say your business is a company and the shareholders request audit with 10% or more stakeholder, they request audit, then you may have to do audit, although you may be a smaller micro entity, and there could be various reasons for that. So audit, although from regulatory point of view, is not compulsory because you are a small company or a micro entity, but shareholder may still request an audit of the company. This audit is not necessarily for the companies. It could be also for a partnership or LLP. The audit requirement has changed from 6th April 2025, and so there are higher limits. Before 6th April 25, there were lower limits. Now coming to payroll. So there are various compliances for payroll. Employees, first thing first, employees need to register an employee when they onboard into the payroll systems. And then on monthly basis, or in some cases, maybe weekly or fortnightly basis, you may have to deduct income tax, national insurance, and then pay to HMRC. You need to make sure you calculate the deductions, pay everything correctly, and then the amount, the payroll is processed before 5th of the next month, the pay month. If your pay month is, say, December, then by 5th of January, you need to make sure it is submitted to HMRC, or otherwise penalty may apply. The submission is in real-time basis. So you provide, we call it RTI. It's a mandatory reporting to HMRC for each pay cycle. Whenever you pay to your employee, you have to make sure you submit that information to HMRC, and with all the details, with all the deductions. HMRC taxes, so that includes PAY, NI, both employee NI as well as employers NI. That needs to be paid to HMRC by 22nd of each month. So for December, you have to pay by 22nd of January. Otherwise, the business may have to incur penalties. Now, one thing here is, I'm sure most of you are aware that employers' national insurance, you can claim employment allowance up to £10,000, depending on certain criteria. And most of the small and micro entities are entitled to claim that. Then you have some year-end compliances. These year-end compliances includes P60. So you have to issue a yearly salary certificate, which is called P60. That includes details of the employees and taxes and gross income. If the employee leaves the job, you have to issue P45. Other than that, you have to also make sure if there are any benefits given to the employees, then you need to file P11D, which is a return for benefits in kinds. Of course, there are taxes applicable on that, so you may have to pay taxes in time, and there are deadlines for the same. Moving on to pension-related compliances, there are many compliances, and most of you may be aware of Auto Enrollment Act. First thing first, you need to assess staff. So assessing staff, what that means is check the age of the staff. Depending on the age and earnings, every pay run, you have to enroll them into the pension scheme. So the minimum age is 22 to start. And if the annual earning is above 10K or equivalent of that in terms of monthly pay or weekly equivalent, then that employee needs to be registered or enrolled into the pension scheme automatically. The employee, when they are enrolled, they get 30 days time to decide whether to stay in or opt out. Otherwise, you need to make sure every month you do your payroll, make sure you assess the position of the employee and then enroll them into the pension scheme you have set up. So every time you run the payroll, you make sure if the employee is in the pension scheme, then there is minimum employee and employer pension contribution to be deducted. Those pension contributions has to be in terms of auto enrollment requirement. It is like 5% employee contribution and 3% employer contribution. In most of the cases, there are people do forget to either upload the monthly contribution to the pension scheme, or sometimes make the contribution, delay in paying the contribution to the pension scheme. Those are the most common breaches or compliance failures when it comes to pensions. So make sure you, first thing first, once you complete your payroll processing, you upload the contribution file to the pension scheme. Some of the softwares, they are linked to the pension trust, and you can straight away submit the contributions from the payroll system to the pension schemes. In some cases, such as I think People's Pension, you may have to download the file and then upload it in the pension scheme to make sure that the contribution appears in the pension scheme, and based on that, you then pay the pensions to the pension schemes. Opt-in, opt-outs, like, there are processes, there are communications to be issued to the employee, to the pension scheme. Make sure you update the same. There are also compliances with the pension regulators, which is related to re-enrollment. Every 3 years, you have to make sure you make that compliance with the pension regulator. We call them TPR, and regularly send the letters or communication to the staff. And I think apart from that, you need to make sure that you have all the information or record keeping up to date for the pension. Next, VAT for business. It is mandatory if your taxable supply exceeds 90,000 on 12-month rolling basis. However, as I mentioned earlier, if your business is below, the gross revenue is below 90K, you can still register for VAT. There are benefits for that. We'll discuss about that. There are different kind of VAT schemes applicable. The most popular ones are standard and flat rate, which is applicable for small or micro entities. Now, standard is where you pay, you collect input VAT and pay for the net VAT after collecting from your customers. Flat rate is where you have turnover below 150K, and it is purely for small bits micro entities where you are a new startup, and you get some benefit with the standard sort of flat rate, which is applicable on the gross turnover, including VAT. And you don't claim input VAT, actual input VAT on these cases, except where the capital item is more than 2000K. Now, there are different method of accounting for standard sort of standard VAT, which is cash scheme, accrual scheme. Cash is where you record your income and expenses based on what you receive and what you pay. Accrual basis is where you record your income and expenses based on what you have earned. You may not have received it, or what you have incurred, but you may not have paid it. Now, with accrual scheme for small businesses, it is sometimes disadvantages because you may not have received money from your customer, although you have charged VAT on the bill. You may have to pay that because you are under accrual scheme. So if you're not under right scheme, you may want to transfer to cash scheme if possible. There are different rates applicable for VAT. Standard is 20%, reduced is 5%, and then 0% depending on the nature of services, or most of the services are 20% standard rate, or zero exempt. Reduced are mostly for energy saving materials and different other sort of products. VAT return, you have to file quarterly VAT return again. So let's say your quarter end is December 31st, then you will need to submit your VAT return by 7th of February, and so on. So government already introduced, making tax digital for VAT few years back now, and everyone is paying VAT or filing VAT through MTD. So you can't do it, on your own unless you have MTD compliant software. Next, corporation tax. This is for only companies or LLPs. Now, in this case, you first register, as I mentioned earlier, you register your company with HMRC and get the UTR number. Annually, you need to file tax return for the company within 9 months within 12 months from your company's year end. It applies to all the limited companies, foreign companies with UK branches, and certain associations such as clubs and co-ops. Now, what is corporation tax applicable on? It is applicable on all the income you book. Um, by the way, your VAT may be on cash basis, but for corporation tax purposes, you have to adopt accrual basis of accounting. So whatever you have built is your income, and then whatever expenses you have incurred, regardless of whether you have paid or not, is your expenses. The net is your profit on which tax may apply. Now, there are various other things which comes into play when I talk about corporation tax. One of such thing is capital allowances. Of course, that's applicable also in case of self-employed, where you have assets. So in the books, you may provide depreciation for writing of the assets based on the life of the asset. But for tax purposes, you used capital allowances, which is as per, in case of company, it is as per taxation rules. And if your business is, doing any sort of research and development work, then you may be also eligible to claim something called R&D tax relief, and that is purely based on whether you're doing something really innovative, something new, which is not already available in the industry or market, and then based on that, whatever expenses you incur for that towards that R&D, you can claim R&D tax relief against that. Corporation tax rates, it up to £50,000 of taxable profit, it's 19%. Once you exceed 50, up to 250, there is a staggered rate which changes, and you basically it's 25% rate less marginal rate of relief. If your taxable business's taxable income is more than 250K, then there's a 25% tax rate. So it is very difficult to say what is the tax percentage applicable between 50 and 250. It varies. It could be 22%, 24, but above 250K, it's 25%. A compliance requirement, as I already mentioned, you have to file your tax return within 12 months from the company's year end. So let's say your company's year end is 31st December 25, and you will need to file your company's tax return within 12 months, which is 31st December 26. However, you need to pay your corporation tax within 9 months and 1 day after the year end. So for the same example, where your company's year end is 31st December, you need to pay your taxes by 1st of October 26. And as mentioned earlier, you need to maintain records of all your accounts, transaction, and all the businesses. Now, next is company secretary duties. This is purely for limited companies, wherein you need to maintain all your statutory records for businesses. That statutory register includes your memorandum, article of association, certificate of incorporation, directors registers, PSC registers, and many other books. Now, if you all know, recently Companies House or Companies Act introduced a new requirement, which was applicable from 18th November. It's the identification verification for directors as well as for PSCs. So the new process now requires that you need to do your KYC with Companies House. You can either do it directly or go via something called ACSP, which is Authorized Corporate Service Providers. They are, kind of already registered with HMRC. With the Companies House. We are like ACSP, so accountants, solicitors, they can verify the directors or person with significant control, and then confirm with Companies House that we have already verified the directors. Based on that, then Companies House sends the personal code to the directors or person with significant control. And then next time when you need to submit, say, annual confirmation statement, or say if you need to submit any other sort of changes for the company, then you will need to use the PSC, sorry, the personal code to make any submission to the company's house. So let's say your next annual confirmation statement is due in February. Make sure you complete your ID verification so that you can submit your annual confirmation statement. So annual confirmation statement is another sort of compliance for companies, which is mandatory once every year on the anniversary. Within 14 days from the anniversary of the company, you need to submit annual confirmation statement. Annual confirmation statement is basically a small sort of submission to the company's house wherein you update all your company's details, such as who is the director, what is the director's address. If there is any change in directors, then that needs to be reflected there. If there is any change in shareholders, if there is a new allotment of shares, then that needs to go on the annual confirmation statement. If there is any change in the business, such as SIC code, so let's say you are doing market research, now you've added another service, then you need to add that code, then that you can do only through annual confirmation statement. There are sort of other details such as change in PSC. So once you issue shares to another person or a lot more shares, then the PSC may change. Now, I've been using the acronym PSC for quite some time. I hope you all know PSC means person with significant control. So any person who owns 25% or more in a company are treated as PSC. And there's a special sort of compliance and requirement and disclosure in the company's house for PSCs. So you need to make sure that you meet with all those compliances. Any changes you make in the company, such as change in directors, change in registered office, allotment of shares, there are separate sort of compliances which you have to do then and there within 14. Mostly these changes you need to report to the company's house within 14 days. And you may need to, if there are more than one director, you may need to get the consent of other director or sometimes shareholders and get the board resolution signed before you do the compliance. So the various compliance come into play. You need to make sure you maintain records of all the meetings and board resolution minutes, etc. Now, all these compliances, why these compliances matters? There are various reasons. One, it is to maintain investor trust. If there are investors in your business, if there are multiple shareholders, it creates, uh, a good order for the business. It provides more reliable financial information, records, and also consistent and transparent for investors. It also strengthens, it also sort of gives positive um, vibe for the business. It creates confidence with the investor that the company is well managed and good practices are followed for compliances. Also make sure that HMRC companies house, those penalty can be avoided if you do timely compliances. There are many compliances for the business. If you are not aware, of course, you need to make sure you meet those deadlines. Otherwise, you may have to pay penalties in form of delay in filing or interest in case where you have to pay taxes. And if you are delaying in paying taxes, then HMRC may charge interest on the same. Interest rates are quite high. What HMRC charge in terms of penalty currently, I think it's 8.25%. I think nobody wants to pay that kind of penalty. So I think overall, that was the idea to make sure you are compliant for all your businesses, whatever you're doing. Thank you all for your time, for listening. I hope it gives you some insight into accounting and tax matters for your business. These are our details in case if you want to contact us. My firm's name is R&M Accountants UK Limited. We provide various services, accounting, bookkeeping, company secretarial, payroll and enrollment pension compliance, R&D tax credit relief. We also advise overseas client in setting up business in the UK. We provide advice on corporation tax matters and compliances. We also help businesses in planning and forecasting, business models, taxation for individuals and partnerships. Our contact details are on the right hand side on the screen with QR code. So please feel free to note the contact details.
That was fantastic, Jay. Thank you so much. It's always good to, run through these things, particularly at the beginning of the year, to make sure that we're all compliant and doing the right things. So I don't know if anybody has any immediate questions for Jay. If not, I have a list of questions that I can run through. Anyone out there with a question? Liz, you've got your hand up. Please go ahead.
Hi, thank you ever so much, Jay. I think as ever, these things are full of acronyms and complications. Um, I think a lot of us are actively thinking about making tax digital at the moment. I have an accountant who does all our VAT and tax returns for us, and they put all the paperwork together. But with making tax digital, up until now, for the last 17 years, I've been keeping all my records in Excel.
Mhm.
Um, do I now need to use something like Free Agent on my own system as a when my accountant is actually doing all the returns and keeping the records for me?
Hi, Liz. No, that's a very good question. See, there are two ways to look at it. We also, as an accountant, we receive a lot of information from our clients in Excel for VAT, for payroll, for other sort of business transactions. What we do is we then, post all those transactions on an accounting software. So, such as like we have accounting software, which is, which mostly accountant uses, or even, we give access to the clients. So I'm not sure what sort of arrangement you have got with your accountant. But it is always easier if you have your own sort of software and if you're able to post the transaction within the software. Sometimes I see clients, they have knowledge and they are able to post transactions correctly in the accounting software. But not every business person has knowledge of accounting, what to debit, what to credit, and what transaction to put where. In which case, you better, you pass it on to your accountant and then they, justify posting in the right place and making sure transactions are correctly recorded and reported to HMRC or to Companies House or other authorities.
Yeah, no, oh no, that's helpful. I mean, I would say I used to do my own VAT returns and then realized I was not doing some elements correctly. And I think with VAT, especially as with services industries, it's very easy to get things wrong, especially if you've got international transactions. So I decided it was easier to leave it to my accountant because they knew how to do it properly. But no, that's helpful. I probably should use something like Free Agent so I can, or I'll talk to my accountant in terms of what they recommend I should use. Maybe maybe something like Zero or something so that it can power straight through to them. But I just leave it to them. But I was a bit concerned that I might have to use a piece of dedicated software. It sounds like probably not.
I think it always helps as being an accountant. If I get information recorded on the software, which these
Mm,
days is quite simple also because
yeah.
of the tech. There are a lot of tools. So Free Agent, particularly as you're referring. See, if you have account with any of these banks these days, they provide they are connected to one or other accounting software. So if I'm not wrong, from NetWest, you can directly post, or even from Starling bank account, you can directly post your transaction into Free Agent. They are linked somewhere.
Mm,
So let's say whatever expenses you've incurred from the bank when you're making the payment, after that you can post it then and there that this is for, let's say, accountant fees, this is for professional charges, this is my tax payment,
yeah.
because you will know the nature of transaction. And I think that the system from the bank gives you option to put it in the right place. If you do that, if it is posted and it goes to the accountant, definitely saves their time. But if it is
Mm.
complicated, or like, of course, year-end adjustment, accruals, prepayment, depreciation, all that may be quite complicated. So yeah.
Thank you.
Liz, can I just check? Are you a sole trader or a limited
We're a
company?
limited company.
Yeah. Okay.
Yeah.
So you don't have to do making tax digital. You can,
No, no, I hadn't realized that until this session today, actually.
yeah.
So thank you. But I think it seems to be a good practice to get into if you can.
Akanksha, your hand's up.
Yeah, I was just gonna say that, Liz, is basically I think what would happen is If you don't do it, then your accountant will have to do it quarterly, and then they're charging you 4 times the fee. So just be aware that it's coming to you some way or the other. If you keep it in Excel, they will have to do it because it's a mandate. So I've recently done a couple of projects for these MTD companies, and that's basically their mandate is if you don't do it, they have to do it, and so therefore it's extra charge that the accountants will charge you for that time.
That's a
Thank
good
you.
point. Although my accountant is very inexpensive, so it's fine. Thank you.
Any other questions from anyone? No? Okay, so let me have a look at these questions that I think we put out a little survey not very long ago before Christmas to see what sort of topics people wanted to discuss. The first question we have for you, Jay, is what about how do we manage cash flow effectively in a business? Have you got any tips on that?
Sally, that's really good question, and it is really important for small businesses where, the cash flows may be quite, um, you know, um, difficult to manage on month-to-month basis. So first thing first, I would say if you can create a cash flow forecast for your business, maybe it's a small in Excel, or if you have a software, if the business is, growing and have a lot of customers, etc., then better to do it on a software. Then make sure you promptly invoice to all your customers and try to collect the payment as quickly as possible. Of course, you will have set payment dates, etc., but make sure your credit control wise you're quite strict on that. Now, on the other side, paying to the suppliers, you may want to pay them align in such a way that your payment falls after you receive the money. So that gives you some leeway in terms of cash flow. Again, when it comes to payments like your rentals, your VAT payments, PAY, etc., you can align it so as to go in time to meet your deadline with HMRC, etc. But at the same time, you pay so as to ring fence your cash flow in that way. Um, you may also want to, build a buffer for your cash and expense accordingly for your capital items, etc. So those are the few tips for cash flow management.
Okay, thank you. What about if I have a limited company? What are the different options for withdrawing money from my company?
For withdrawing money from your company, there are multiple ways. One is salary. When you withdraw salary from your company, I would say try to keep it low from tax point of view, because on salary, although you will save corporation tax in the company, NI will be applicable. Both employees and employee NI will have to contribute. Um, the other way method is dividends. You can take money by dividend, but to get dividend, you will have to make sure you have enough profit in the business and reserves from previous years. You can only take dividend from the company from the profits or reserves, and it is not tax deductible, whereas salary is tax deductible. You can also take money in the form of pension contribution, so you can pay directly to your pension pot. However, that will get locked until the retirement age. There are many people who always have spare cash in the business and they want to save tax, so it's quite a popular method as far as UK taxation is concerned. And then you can also withdraw money in the form of reimbursement of expenses, which are the actual business expenses. And normally, you have to make sure you balance all these.
Okay. That's useful. Any questions, any immediate questions from anyone? If not, is it better to take, from a tax efficiency perspective, is it better to take salary or dividend?
That's a very good question. There's no, single answer for that. Either salary or dividend depends on, mostly what we suggest is a balance of both, depending on the business. What kind of profit in the business? See, salary, if you are taking salary, normally, up to personal allowance limit, which is 12,570, there's no tax on it. But after that, it is 20% tax. And there's also NI applicable. So if you are running your own business and you are the single sort of shareholder director in the company, then you will of course have to incur your national insurance, unless you have any other employee, in which case that you get to claim employment allowance to £10,000, in which case you're not paying that. So that is fine. So depending on these circumstances, you have to decide your salary, and it could be beneficial to take salary, then up to a certain limit, then dividend, because dividend is after paying corporation tax in the company, which could be 19 to 25% depending on the company's taxable profit. And after that, once you include that dividend in your personal tax return, only up to £500, subject to certain, of course, limits, etc., is exempt. After £500, there is 8% tax on 8.25% tax on dividend. So you know you have to balance and come out with the right sort of tax efficient salary plus dividend.
Okay, that's useful to know. Thank you. What about expenses? Is that tax free? What expenses can you set against the business activity?
So, see, the simple thumb rule is, if the expenses incurred are towards businesses, purely for business purposes, then of course you can claim it and withdraw, either in the form of reimbursement or directly pay from business. This could be like your telephone, your mobile bills, which are purely used for businesses, mileage claim, which is when you travel from or the fuel claim when you travel from your own place of work to clients or meeting or client's business or things like that. Then you can claim that, which is 45p per mile, or in case of fuel, or in case of electric vehicle, it is 0.25 pence per mile. And other than that, you can claim expenses for your laptop, for your broadband, those kind of stuff. As I said, the thumb rule is, purely for business purposes. If there's any element of personal expenses, then you may have to treat it as benefit in kind, and then pay tax on it at the year.
What about people working from home and the use of an office within their own home, for example, or electricity charges and things like that? What can people deduct for office space,
Sure.
home office space?
Sure. Yeah. So working from home, there is a standard £312 per annum, which you can put through your accounts and claim as expenses. £312 is not good enough for some people, where they're purely working from home. There is no other office. They're working out of 365 days, say 200 days, and say 7 hours every day. So HMRC has a method of arriving at the sort of pro rata allocation for working from home, which is based on, you take all your expenses such as electricity, gas, and I'm not talking about, of course, mortgage. Mortgage is not allowed. It's a bit gray area, because that you have to pay regardless of you are working from home or not. But there are things which are more like variable cost, wherein if you have a say 1 out of 3 room in the property, you allocate 1/3 or of the total area of the property and prorate and take all the expenses. Then on pro rata basis, the number of rooms you are using or the area you are using in the home. Then you also consider number of days of working days in a year, divide by 365, and you come up with an amount which you can claim. So if HMRC later on inquires on what basis have you claimed, that's the formula, which is the guide from HMRC.
Okay, that's useful to know. Thank you.
No problem.
Okay, what's the biggest mistake directors make when taking money out of their business?
Wow, that is one real, good question. A lot of people, directors, they treat their company as like, company's bank account as personal wallet. Now, what that means is they think that, of course, this is my money. I can take whatever I like, and I don't have to pay tax on it. See, what I suggest is, you can withdraw money from your company's bank account. However, name it, whether it is for towards salary, whether it is towards dividend, or towards reimbursement of expenses. If it is not any of these, then it automatically goes to something called director's loan account. And when you prepare the year-end accounts, what happens is that money will be treated as loan and will be disclosed. We'll have to, we have to submit to in the corporation tax return as loan, and on that it's called Section 455 tax charge, which the directors will have to pay. So if you by mistake overdraw your, against the salary, dividend, and then reimbursement, if you overdraw, that's fine. You can still pay that back to the company and not pay tax on it as far as it is within £10,000. That money is to be paid within like 9 months or before, from the year end or before you submit your accounts to the HMRC. So there are certain rules around that.
Okay, that's useful. What else? Just this isn't on the list of questions, Jay, but I'm just wondering when you have a limited company and you have a certain amount of capital reserves within the company.
Mhm.
If you want to wind down your company and withdraw the reserves that are in the limited company, what taxes apply to that?
So, see, there are various methods and depending on the amount. So there is no single answer, but I'll tell you one that there is, business relief, which earlier used to be called entrepreneur relief. So what you can do is if you want to wind down the company and say you have 200,000 or 300,000 in your business, which is left over.
I wish.
So you can take that money and then you pay a lesser amount of tax. Earlier, as I said, it used to be entrepreneur relief tax, so 10%, and there's also limit used to be £1 million, which has changed over, the budgets, last budget and stuff. So that is one method. But for that, you have to wind down the company. You have to go through official liquidator who will handle the process. Of course, there are charges for that. So that's the method. We don't normally, I don't have a liquidator license, so I don't normally, deal with that kind of thing. That is one option. Other option is you can continue to take, whatever reserves you have in the company. If it is not a big amount, you can, continue to take dividends or, if you have leftover profits. And then finally, capitals are normally £100, £1,000. Sometimes, some cases, of course, you have higher capital, in which case there are again two sort of methods. One is buy back your shares, and there are different, sort of processes, compliances for that kind of thing. To, after paying your dividend, you can take your capital, but there are compliances for same.
Okay.
Sorry, it's not. I hope
Like,
it's not too complicated.
yeah, it sounds like it needs a little bit more thought and examination. Okay, that's great. Any other questions from anyone? No? Just one time for one last question. What is the benefit of registering for VAT voluntarily? So if you don't have a big turnover, and you're not necessarily at that threshold where you actually have to do it, what are the benefits of doing it voluntarily?
So there are few benefits, and the simple ones, straightforward ones. When there's a new startup or a new business wherein they are incurring quite a few expenses, particularly say capital expenses, and you are paying VAT, say buying laptops, say plant and machinery or things like that, furniture. You can claim VAT by registering voluntarily, and you don't have to pay because you may not have, the business may not have initial revenue, etc. So it is popular for startups, for new businesses where there are higher expenses, and so as higher VAT to claim. Yeah, so that is one of the
Main
it
benefit.
also, of course, when you register for VAT, and if you want to grow your business, or if you want to, normally, if you have big clients, most likely in case of food products where you need to get listings with the big stores or things like that, then they ask for VAT numbers. So it also provides sort of that you are, yes, permanent, you are registered for VAT. It gives more credibility for the business with the large suppliers, large customers, etc.
Okay, brilliant. Thank you. Okay, well, I think we've run out of time, unless anybody has a last question for Jay. I can't see anybody's hands up. So thank you very much indeed, Jay, for your time and for running through that for us. Can we have copies of the slides? Can we share those copies with people who've attended? Are you happy for us to do that?
Yes, that's absolutely fine. Yeah.
Fantastic. Thank you. Okay, well, one question quickly from Mike. Oh, is that a
Waving, I think he's
I think
waving.
he's waving. I think he's waving, not a question. Okay. Well, thanks very much, everybody. Have a wonderful afternoon. Thanks again to Jay. It's been really useful.
Thank you, everyone.
Bye,
Have a good
everyone.
afternoon. Thank you. Take care. Bye bye.